Okay, let's unpack this. If you're serious about, building wealth and actually keeping it, there's this one foundational text that all the greats like Warren Buffett and, well, everyone point to. It's the absolute starting line. We are diving deep today into Benjamin Graham's classic, The Intelligent Investor.
Oh, absolutely. It really is the definitive guide. I mean, it's called the Bible of value investing for a very good reason.
Yeah.
And, when you think that Graham developed these ideas right after the Great Depression, well, it makes sense why the whole book is kind of built around safety. Safety first.
That focus on survival, on managing risk,
Yeah.
that's why it's lasted, isn't it? Graham was Buffett's mentor, literally.
Yeah.
And Buffett just keeps saying it. By far the best book on investing ever written. So our mission today is really to give you the core framework.
Yeah, cut through some of the denser parts, maybe.
Exactly. Extract those timeless rules for building wealth, but crucially, while minimizing risk.
Right. And Graham's genius, it really starts with a simple philosophical split. Before you even think about investing $1, you have to decide what you're actually doing.
Right.
Yeah.
Because you can't really aim for financial security if you don't know if you're, running a long-term strategy or just feeding a gambling habit.
That's his first big distinction. The line between investment and speculation. For Graham, true investment is, well, it's based on thorough analysis.
Looking at the actual business, the fundamentals.
Exactly, the business fundamentals. And it has to guarantee the safety of your principal and offer a satisfactory return. You're essentially buying a piece of a real company.
And speculation then is?
Speculation is basically everything else. It's chasing short-term price moves based on hype, maybe a rumor, or just guessing what the next guy will pay.
No real analysis there.
No. And Graham really stresses that you must avoid confusing these two. Because the mindset, the skills needed, they're completely different. Polar opposites, really.
I think that's maybe the hardest rule for people, especially when the market's, going crazy and everyone seems to be making easy money.
Oh, for sure.
But that emotional challenge, it leads us right into his core ideas for managing the biggest risk factor, which is usually ourselves, right?
Absolutely. His methods for controlling that behavioral risk, they're legendary. And none more famous, I think, than how he personifies the market itself.
Yes. Here's where it gets really interesting. Graham gives the market a name, Mr. Market.
Yeah, think of Mr. Market as your business partner. But he's highly emotional. Manic depressive, basically.
Oh.
He shows up every single day, offers you a price for your share of the business, but his price, it swings wildly because he's completely driven by fear and greed.
So one day he's euphoric, offering way too much.
Right. And the next day he's panicked about, I don't know, some news headline, and he's practically giving the business away.
So the key lesson is discipline. You treat Mr. Market like a helpful quote machine, not a guide telling you what to do.
Exactly. He's there to serve you, not instruct you. If he's pessimistic and prices are low, maybe you buy.
And if he's overly optimistic, prices are inflated. You just hold, or maybe sell.
You hold or sell. The point is, you decide based on your analysis, not his mood. You're to control your own reaction to all that external chaos.
Okay, but let me push back a bit there.
Yeah.
What if you're watching a stock you own just plummet, say 30%, because of some general market fear, and everyone online is freaking out? Isn't telling people to just ignore Mr. Market a bit like confirmation bias? Just ignoring bad news.
That's a fair challenge, but I think Graham's rule isn't really ignore information. It's more like ignore emotion. The panic is Mr. Market having one of his fits. If you've done your homework, the actual investment analysis, then a price drop caused by widespread fear. Well, that might just be an opportunity.
Not necessarily a reason to panic sell.
Right. The price reflects Mr. Market's mood, not necessarily the intrinsic value of the underlying business.
Okay, that makes sense. And that concept, intrinsic value, it leads directly to what he called the most important concept in the book, right?
Absolutely, the margin of safety.
Let's define that one carefully, because this sounds like where the real protection comes in.
It's pretty straightforward, actually. It just means you must always try to buy security when its market price is significantly below what you calculate its real intrinsic value to be.
You need that gap, that cushion.
That cushion, exactly,
Right.
that buffer. For Graham, it wasn't enough to just find a, say, fairly priced company. You needed a discount.
So finding a stock you think is worth $100 and paying $100 for it, that's not good enough for Graham.
Nope, not safe enough.
You need to find that $100 stock and insist on paying, what, maybe $60 to $70.
Something like that, yeah. That gap, that $30 or $40 difference, that's your margin of safety. And it's crucial. It protects you from so many things.
What?
Well, the obvious ones. A big market crash, a recession you didn't expect. But also, it protects you from just being wrong in your own analysis.
Errors in judgment.
Yeah, we all make them. So that margin is your primary safeguard. It's what keeps you from ruin when things go wrong, because things inevitably do go wrong sometimes.
Building on that, Graham was working in a time, post-depression, where intrinsic value was maybe easier to grasp, tangible assets, factories, inventory.
Right, balance sheet stuff.
But how do we apply that margin of safety today when so much value is tied up in intangible things, brand value, user growth, companies that don't even make profits yet?
That's a really important question. The core principle, I think, is timeless. But applying it today, it's definitely trickier.
So what do we do?
For modern investors, calculating intrinsic value means you have to look beyond just the tangible assets. But you also need to be, more conservative about forecasts.
Especially for growth way out in the future.
Exactly. If a company isn't making actual cash now, your margin of safety demands an even bigger discount. You need high certainty about future profitability, not just optimism or hype. It forces discipline when you see those really high valuations.
Okay, that helps frame the challenge. So you've got this mindset. Safety first. Ignore Mr. Market's tantrums. Demand a margin of safety. What next? Graham then helps you figure out what kind of investor you actually are.
Yeah, he recognizes not everyone wants to or even can spend hours digging through financial reports. So he defines two main paths.
The first one is the defensive investor. Who's that?
That's the person who prioritizes keeping their wealth safe. They want minimal risk, steady, reliable returns. Think diversification.
So things like index funds, maybe some solid blue chip stocks that pay dividends, bonds.
Exactly. High quality, reliable stuff. It's the path for most people, honestly. It minimizes the time you need to spend while still getting broad market exposure.
Does Graham say they can't buy individual stocks?
No, not strictly forbidden. But he sets really high bars for quality and financial strength if they do. The main focus is always, sleeping well at night, security.
Okay. And then the other path.
Yeah.
The enterprising investor.
Right. Now, this is for someone who's willing and able to put in significant time and effort.
Doing what exactly?
Actively hunting for mispriced stocks, analyzing special situations, maybe finding companies that are genuinely undervalued that the wider market has just overlooked.
So more work, potentially more reward.
Potentially, yes. It requires deep, original analysis. You often have to be willing to look wrong, or at least unpopular, for a while. But if you're right, the returns can be much higher.
But whether you're defensive or enterprising, both paths seem to demand something that the financial news cycle often forgets. The whole mental game.
Oh, Graham is absolutely insistent on this. He believed successful investing is maybe 80% behavioral control. It takes enormous discipline, patience.
And that ability to control your emotions.
Ruthless control. Conquer greed when everyone's euphoric and conquer fear when the market's tanking.
It's easy to say, hard to do. It feels rational when things are calm. But when everyone else is making, 50% on some crazy meme stock.
Yeah.
Or the flip side, when your portfolio gets hammered. Those emotional decisions, selling low, buying high, they can destroy years of work.
They almost always lead to losses. Graham's point is stark. You are your own worst enemy in investing.
So the key lesson is, what? Combining the math with the mind.
Pretty much. The best investors blend rational analysis that's applying the margin of safety with ironclad emotional discipline. That means refusing to let Mr. Market's moods dictate your actions.
Okay, let's pivot then to modern relevance. It's easy to think, okay, 1949, fine. But the world's different now. Steel mills versus software, right? How do we actually use this wisdom in, say, 2025, in a market driven by algorithms, social media, constant change?
Well, the beauty of Graham is that his core insights are timeless precisely because human nature hasn't really changed.
Fear and greed are still fear and greed.
Exactly. The tools change, the emotions don't. So we can definitely distill his non-negotiable rules for today.
Okay, what's rule number one? The absolute must-have according to Graham.
Patience. Simple as that. First rule. Don't chase quick profits. Invest for the long term. That immediately minimizes the damage Mr. Market's daily fits can do.
Makes sense. Rule 2. Safety in numbers.
Diversification. It's not just a good idea. For Graham, it's mandatory. It reduces the risk that one bad bet blows up your whole plan.
Okay. And rule 3 feels like Ignore the noise.
Pretty much. Avoid market hype and speculation. Doesn't matter if it was tulips, the dot-com bubble, or the latest crypto craze. The principle holds. If everyone's shouting about it, you're probably late to the party.
Right. Stick to your analysis, which leads to Rule 4.
Stick to fundamentals. Always look at the actual business. Earnings, assets, dividends, or, in today's world, maybe realistically projected future cash flows if earnings aren't there yet, but real numbers.
That feels incredibly grounded, actually. Very practical. But you mentioned the book's age earlier. Aside from maybe some dated examples, are there weaknesses for a modern reader?
I'd say yes, there are a couple of things. While the principles are, frankly, perfect, the book itself, it can feel old-fashioned. It's heavy, it's dense, it's not exactly a beach read.
Okay, fair enough.
But the huge saving grace is that most modern editions include commentary by the financial journalist Jason Zweig. And his sections are fantastic.
How so?
He basically updates the context, provides modern examples, translates Graham's ideas into today's market realities. It bridges that gap perfectly. It's essential, really.
So it's not necessarily a book you read for, like, light entertainment. It's
Yeah.
more like required reading, a textbook for financial literacy.
That's a great way to put it. The final verdict is pretty clear, I think. The Intelligent Investor is not a get-rich-quick scheme. Absolutely not.
What is it, then?
It's a manual, a guide for building long-term, maybe even less stressful financial security. Its relentless focus on risk management and making rational decisions, that makes it essential. For beginners, for experienced investors, anyone seeking a disciplined path.
That strong endorsement, plus Buffett's constant praise, and just the fact that it's still so relevant after all these decades,
Right.
it really cements it as a foundational text. If we just quickly recap those core ideas, Mr. Market, the margin of safety, emotional discipline, they really do form the bedrock of smart investing thinking.
Yeah, and we've established that patience and that discipline. Those are the real keys. If we had to rate the book purely on its lasting impact and, its practical advice for navigating financial ups and downs, it's easily a 9.5 out of 10.
Wow, that's high praise for any book, let alone one about finance.
Yeah.
Okay, let's try and apply this right now, just as a thought experiment for everyone listening.
Okay.
If Graham says true security comes from buying when Mr. Market is most pessimistic, when things look scary, what current, maybe huge, maybe frightening market headline out there represents a potential low price point? A place where fear is high, and maybe, just maybe, there's a margin of safety opportunity that most people are too afraid to even look at right now.
That is the challenge Graham leaves us with, isn't it? It forces you to think critically, to look past the herd mentality.
Exactly. Not just being contrarian for the sake of it, but being contrarian if it's backed by solid fundamental analysis. Well, that's definitely something for you to mull over until our next deep dive.
Absolutely. Thanks for diving in with us today.
We'll see you next time.